Hello, Megan and Michael. Thanks for coming in today. It's good to see you again, and I hope your summer's going well. Today, I wanted to talk with you about your retirement savings and income planning. Just a little refresher for your retirement. You mentioned you'd like to have retirement income equal to 80% of your pre-retirement income, which is $99,200 in today's dollars. Uh, your plan to retire in 17 years when Megan turns 67 and wish to assume a retirement period of 25 years during which inflation we assume to be 3.5%. Uh, for this analysis, you did not want to include Social Security retirement benefits into the calculation. You asked me, uh, as you asked me, I analyzed how much capital you would need for retirement based on both the capital annuity approach, also known as the capital utilization approach, and the capital preservation approach. Based on your current retirement assets, you will have a significant shortfall at retirement using both approaches. Using the capital annuity approach, your shortfall at retirement is projected to be $1,238,651, and using the capital preservation approach, your shortfall is projected to be $1,456,071. I have calculated. The good news is, though, that there is several ways to make up the shortfall. First thing to discuss is potentially funding additional retirement accounts per year. Um, and what I've done is I've calculated a level payment approach as well as a serial payment approach that is needed to cover the shortfalls. Most individuals like to use a level approach, but making serial payments is usually more realistic because it factors in inflation. Starting with the capital annuity approach, level payments for level payments come out to $30,550 a year, and serial payments starting with $24,698 that increase 1.035% each year needed to adequately fund your retirement. For the capital preservation approach, level payments of $35,913 or serial payments starting with $29,034 and increasing 1.035% each year are needed to adequately fund your retirement. Um, Based on these amounts, there's a couple ways to go about it, as I mentioned. The first one I recommend is that you guys take advantage of your company's profit sharing plan with a Section 401k feature. 401ks allow you to contribute 18,000 per year on a pre-tax basis. If you are 50 years or older, you can do an additional catch-up contribution of $6,000. Your company's plan allows you to contribute up to 20% of your salary, which is 20,000 for Michael and 4,800 for Megan. However, Michael, since you are not over 50 yet, you'll be limited to $18,000 until you turn 50. Um, Another great feature about your 401k is that your company also matches 50 cents for every dollar contributed up to the maximum employer contribution of 3% of salary, meaning if Michael contributes at least $3,000, ABC will match with $1,500. And if Megan contributes at least $720, ABC will match with $360. So this is free money on the table here. Don't really need to do anything extra. I highly recommend you take advantage of this because this will help you reduce the amount of payments you need to make out of pocket each year and obtain your retirement goals. Another advantage of contributing to your 401ks is that the contributions are made on a pre-tax basis, which helps you reduce your tax bill. Because you expect your retirement portfolio to earn 10% pre-tax average rate of return in both pre and post-retirement, I recommend you invest in the XYZ fund that's available in your 401k. This fund tracks the S&P 500 index, and going forward, is expected to return 10%, which is in line with what your expectations are for your returns. Once you've maxed out your 401k contributions, I recommend contributing to IRAs next. Individuals under 50 can contribute $5,500 a year, and individuals over 50 years old can contribute an additional catch-up of 1,000 total and 6,500 per year. There are two types of IRAs available to you: a traditional IRA and a Roth IRA. For traditional IRAs, contributions are tax deductible up to the modified adjusted gross income of $99,000 and phased out until $119,000. Your investments grow tax free, and withdrawals after 59.5 are subject to taxation but no penalties. Now, if you make withdrawals before 59.5, they are subject to a 10% early withdrawal penalty. And as well, you must start taking required minimum distributions at also known as RMDs, once you reach age 70.5. Check with your accountant or tax professional to determine your modified adjusted gross income to see if your contributions to a traditional IRA would be tax deductible. The other option, a Roth IRA, is a little different. Contributions are not deductible. The one similar feature is that your investments do grow tax-free, and withdrawals after 59.5 are not subject to taxes or penalties. So it's a great little feature there. Your modified adjusted gross income must be below $186,000 if you're married, filed jointly, to be able to make full contribution to Roth IRAs. Since your total income is only $133,501, I can assume that your modified adjusted gross income does not exceed the limit. And you can make contributions to Roth IRA. I recommend you both fund a Roth IRA because combined with your 401ks, it will give you one taxable bucket and a tax-free bucket to pull from. For example, let's say you're age 72 and you need X amount of dollars that year, but don't want to trigger a big tax bill. By having both accounts, you can take a portion from your taxable 401k. Again, with the 401k, it goes in pre-tax, it grows tax deferred, but when you take it out, it is taxable. So you take that out up to a certain point, keep your taxes low, and then any extra money you need, you can then pull from the Roth IRA because it comes out tax-free. So it gives you a bit of flexibility in retirement by having both buckets available to you. And it's a common thing I recommend for my clients. Now, if increasing your retirement savings is not possible, there's a few other ways to go about making retirement feasible for you both. This is something we want to discuss further in detail. I did not get your thoughts or opinions on these matters when we first met. But just to list them off here, we'll discuss this after I list these. Other ways to help with retirement is one, retiring later in life. Taking an extra few years to retire or working a little more can significantly change the amount of money you need in retirement. Two, you can work part-time in retirement. Now, that being said, a lot of people, some people don't mind that, some people do. So it's a personal decision. This is something, again, as I mentioned, we need to talk about and see how you feel about this. Three, you can look at reducing your retirement income. If you think $99,200 in today's dollars is more than enough, maybe you look at $80,000. That is something we can, if you're comfortable with, I can run the analysis and give you an idea of what that means for you in your current state. Four, we could increase the asset allocation of your investment portfolio to increase investment return, but this does mean you have additional risk to take on. So we'll have to weigh those options there again. Are you comfortable taking more risk in hopes of more return? So another option there. And then lastly, I know you mentioned you don't want to factor in Social Security, but because of the significant shortfall, we can factor that in and see where that gets you. Now, again, this is something we'll discuss going forward. And based on what you tell me, I will factor that into the plan and make adjustments accordingly.